Over the last few months, stocks have seen volatility or big price swings up and down. But one area of the market that has held in relatively well is high yield. Here to explain is Shawna Millman from TD Asset Management. Thanks for being here.
Thanks for having me.
I want to kick things off with your chart, Shawna. Your analysis looks at the 34-year average annual credit losses from Moody's. It compares buying a bond in each credit rating. For example, in the BBB space near the middle of the chart, the gray bar shows that an investor, on average, could risk losing 10 basis points or 0.1% of what you paid for the bond. This could be caused by default, which comes from a missed coupon payment, bankruptcy, or distressed debt exchange. Next, let's move to the black line. This shows the spread. This is the premium an investor receives over treasuries for investing in each credit category. And finally, the green bar is the spread. So the black line minus the average credit loss, which is the value in the gray bar, making this what we call the risk-adjusted compensation you get for buying a bond. Before we get into the numbers here, Shawna, there are a lot of misconceptions about high yield. What could you tell us very generally about the market?
Well, high yield refers to bonds rated BB and below, and it generally refers to companies with high leverage. That leverage could come from M&As, LBOs. Companies may choose to be high yield and issue debt to fund shareholder payouts. Leverage could be part of the business model, or it could be due to a fundamental problem.
The key to your analysis here is really what you call that risk-adjusted compensation. How would you explain some of your key findings there?
Right. Two things. First, this chart shows that there are inefficiencies in how the market values high yield. After adjusting for losses from default, the compensation is disproportionately higher when you move from investment grade to high yield. Also, even at today's rich levels, there is a case to be made for active management in high yield.
We're going to bring your chart back up on the screen right now, and I want to highlight there's a pretty big spike in the spread. So that's moving from the left side where it says, the BBB space at 144 basis points to the next bar at the BB space at 228 basis points. So we're talking about a pickup of about 80 basis points. Do you think that's justified?
No. The average credit loss for BBBs is 10 basis points. And for BBs, it's 50 basis points. So we're talking about only 40 basis points more in credit losses. However, you're getting over 80 basis points more in spread. And if you look at the combined spread less credit losses, over 40 basis points. The key here is that the sweet spot lies in the move from BBBs to BBs.
Now, in Canada and the US, rates are moving higher, and one of the things that's caused from a market standpoint is some volatility in stocks. But you say this could actually be a good thing for the high-yield bond market. How so?
There's three things to think about at this late stage of the cycle. First, high yield tends to outperform with rising rates because there's a bigger spread cushion. If you have a high-yield bond yielding 6% and an investment-grade bond yielding 3%, the relative impact of a, say, 1% rise in treasury yields is going to be greater for investment grade. Also, in rising rate environments, high-yield companies benefit from a better macroeconomic situation. The second thing is defaults. Defaults are low and are expected to remain low. And finally, high-yield fundamentals are strong. Since the Great Recession, high yield is priced in two crises or mini recessions, the fiscal cliff of 2012 and the energy crisis of 2015. And because of these crises, high yield has reined in some of the aggressive behaviors that we saw towards the end of the last cycle. What we see now is high yield leverage is declining, and the new issue market has been tame with far fewer aggressive deals than we saw in the last cycle.
One of the things I want to ask you about is, separating winners and losers in the high yield space. And I'm going to quote you here. You say you stick to misunderstood companies with free cash flow that can manage leverage through a cycle. What does that mean?
So high yield is yielding about 6%. So it looks like we're getting pretty close to fully valued. There are some large capital structures with high leverage that could topple in a weaker refinancing environment. And unlike 2009 or even early 2016, we think you need to be pretty cautious right now. What we are doing is seeking misunderstood, or what we believe is misrated, companies that do generate free cash flow, and as you said, ones that have demonstrated this ability to manage leverage throughout a cycle.
Are you able to give us some examples of companies that would meet that mandate or those thresholds?
Sure. So one is R.R. Donnelley, which is a commercial printer. Now, this market is mature, fragmented, and in secular decline as companies shift their marketing spend from print to digital media. However, high yield has a long history of some pretty great returns in industries in secular decline. R.R. Donnelley is the largest global player by far. Cash flow generation should come from a variable cost structure and long-standing relationships with its clients, who represent over 90% of the Fortune 100. Also, we think management has better capital discipline than its peers, and it has recently focused on reducing leverage. So another one is HCA. HCA is the largest hospital network in the US in a market where scale is king. This is the best-in-class operator with better systems and better data, which makes for better contracts with insurance payers. Cash flow generation has been strong and consistent and is growing as HCA can cherry-pick hospitals from its weaker competitors. It's also growing due to HCA's expansion of non-hospital assets such as urgent care centers, which is the direction you want to be headed in given the current environment of healthcare reform. Finally, management has demonstrated a long track record of management of a levered capital structure, and although shareholder-friendly activity has risen, leverage has declined. So those are two companies that have demonstrated value in high yield.
Shawna, thanks for being here. You've given us a lot to think about, both from a general market standpoint and even some company-specific considerations.
My pleasure.